Imagine a machine running quietly in the background. While you're sleeping, commuting, or spending time with family, it drops cash directly into your bank account. We're talking about $500 every month. It's enough for a car payment, a monthly grocery bill, or your utilities, without ever having to trade an hour of your time. Generating that income is a matter of simple arithmetic. Your target annual income of $6,000 divided by the dividend yield equals the exact capital you need to invest. For most new investors, this formula creates an immediate conflict. You want the income now, but the math reveals exactly how much money is required to buy it. You're forced to choose between two paths: grinding for years to save a six-figure portfolio, or chasing a double-digit yield to hit the goal immediately. Building a $500 monthly income stream isn't about finding a secret stock. It's about deciding which specific trade-off you're willing to make with your savings. There are three main yield tiers to consider: the aggressive 10%, the moderate 7%, and the conservative 4%. At a 10% yield, you only need about $58,000 to generate $500 a month. This low barrier to entry is what makes high-yield stocks so attractive. Moving to the moderate 7% tier, that capital requirement rises to $85,000. But at a conservative 4% yield, you need $150,000. For someone just starting out, that number can feel like a reason to give up. This gap in cost is how investors fall into the yield trap. High-yield stocks are often promoted as a shortcut, but they rarely disclose what you have to give up to get that check. When you buy the highest yields, you are often sacrificing future income growth and accepting a higher risk that your original investment will shrink over time. The yield you select today determines whether your income will grow with your needs or remain fixed while prices continue to rise. The aggressive path generally involves asset classes like business development companies, or BDCs, and covered call ETFs that yield between 8 and 14%. The benefit is obvious. You get high cash flow on day one. You can hit your $500 target with a relatively small amount of money. But these payouts rarely grow. If your dividend stays flat while the cost of living increases, your $500 will buy less food and less fuel every single year. There's also the issue of principal erosion. Many high-yielding assets have a declining net asset value, meaning your original $58,000 investment could actually be worth less in 5 years than it is today. Then there are taxes. High yields from BDCs are usually taxed as ordinary income, rather than at the lower rates reserved for traditional dividends, which means less cash actually reaches your pocket.
The aggressive path is a specific tool for immediate income, but it's rarely the best way to build wealth that must last for decades. The conservative path targets yields in the 3 to 4% range. This strategy focuses on companies with long track records of increasing their payouts every year. To understand the long-term math, we can look at a 2008 case study comparing a high-yielding telecom company to Visa at its IPO. In 2008, the telecom stock offered a massive 5.6% yield. Visa offered a tiny 0.2%. At the start, the high-yield option paid out much more cash, but we have to track the yield on cost. This measures the income you receive based on your original purchase price. Because the telecom dividend didn't grow, the yield on cost stayed nearly flat. Visa, however, raised its dividend consistently. As those annual hikes compound, your effective return on your original investment moves higher every year. Eventually, you hit the crossover point. By 2020, Visa's dividend growth allowed it to surpass the stagnant telecom payouts, eventually reaching a 12% yield on cost. This path also comes with tax advantages. Qualified dividends are generally taxed at lower long-term capital gains rates, allowing you to keep a larger portion of what you earn. While dividend growth requires more upfront capital, it is the only strategy that protects your standard of living by giving you a raise every year without requiring more of your savings. You can speed up the growth of a conservative portfolio by using a dividend reinvestment plan, or DRIP. This automatically uses your cash dividends to buy more shares of the stock. This process automates your investing, buying more shares when prices are low and fewer when prices are high, which compounds your total income over time. However, using a DRIP in a taxable account creates a heavy record-keeping burden. Every reinvested dividend counts as a new purchase, creating hundreds of tiny transactions you'll need to track for tax purposes. Reinvesting dividends builds your position size automatically, but you should consider using tax-advantaged accounts like an IRA to avoid the accounting complications. The right dividend strategy isn't about which yield is highest, it's about which one fits your current stage of life. To choose your path, start with your timeline. Do I need this income to pay my bills today? If you need immediate cash flow, you are an income seeker. The aggressive or moderate tiers get you to your goal fastest. Be aware you'll need to manage higher tax rates and accept your income might not grow much. But if you have 10 years or more to grow, you are an accumulator. Prioritize the conservative tier and dividend reinvestment. You're giving up a larger check today in exchange for a much larger inflation-adjusted income in the future. High yield serves an immediate need for cash flow, while dividend growth prevents inflation from eroding your standard of living in the years ahead.